In the last month or so, something big just changed for the Canadian real estate industry, but most people don't realize it yet. Starting November 1st of this year, our regulator, OSFI, is going to quietly change how lenders treat rental property income when you attempt to qualify for that mortgage. Now, that may sound insignificant, but trust me, it's not. This one change or policy amendment is basically going to shape the next chapter of the Canadian housing market. So if you guys own a rental property, if you planned on buying a rental property, trust me, this video is for you. What I'm going to do is break down what's actually changing, why it matters to you, what it means for smaller investors who want to keep building wealth, freedom, security. I've put together a free PDF guide for you. It just explains these new rules in very, very simple terms and shows you what you can do next. You can download it in the description below or just reach out to me and I'll send it to you, no strings attached. So first, let's start off with what actually happened. But a few weeks ago, the regulator, OSFI, came out and made a public statement that caused a bit of disruption in the mortgage industry with brokers, realtors, investors, and obviously the internet. They basically said that the income used from one mortgage cannot be reused for another property. Now, on the surface, that kind of sounds fair to most people. But inside the industry, people panicked. Because if what they were saying was true, the entire buy one and leverage that one property to buy another strategy would be dead in the water, right? Which is basically how small investors build wealth in real estate, using leverage. So mortgage brokers were calling lenders, investors were calling brokers, and we needed to get some clarification on what all this meant. Then OSFI quietly clarified yet again that you can still use income for multiple properties, you just can't reuse the same portion twice. We're going to take a look at a quick example to see what this looks like in real life. We're going to use just round numbers. So let's say you earn $100,000 a year. You bought your personal residence a few years ago. But your mortgage, your property tax, insurance, and heat utility typically will take up or eat around 40% of that income. Now, a few years later, if you're looking to buy a small rental property, maybe a condo that you can rent out for $2,000 or $2,500 a month, under these new rules, the regulator has said that you can't qualify based on your full $100,000 income anymore. You can only qualify and use what is left, basically the remaining 60%. And that may not sound like much of a change, but it drastically is going to reduce your borrowing power to the point where it really just won't make any sense. In some cases, if you really do want to push, it's going to be the difference between getting approved with an A lender or getting pushed into alternative lending on the B side. Now, the part of this that I find more interesting is this change isn't really about people's income. It's more about how Canadian lenders, Canadian banks, are now required to recategorize or classify your mortgage behind the scenes. The regulator introduced a very new category called material income dependent loans. Sounds complicated, but it's not. Basically, if 50% of the income that is used to qualify for your mortgage comes from rental income rather than earned income through a job or a business, then that loan now gets labeled as income producing. And therefore, it's now labeled as a higher risk. When a loan is labeled as higher risk, that means the bank or the lender basically have to hold on to more money, more cash reserves in their emergency safety buffer. And when these lenders have to hold on to more money and not lend it out, basically they need to protect their margins. And what they need to do, because they're not making as much money, so they need to either raise rates or they need to tighten rules and lend their money elsewhere. That's basically how a small technical change out in Ottawa can turn into tougher approvals, higher borrowing costs, and fewer options for everyday Canadians like you and I. And now we need to talk about why this matters, or the big picture impact for all of us. Now, this doesn't hurt the bigger, more institutional real estate investors. So if you think about the pension funds, REITs, private equity firms, they have access to large commercial lending, very deep pockets, and teams of people that manage their risk and their financing. So those organizations are barely going to notice. They're not even going to think of this change. right? This change is tackling everyday investors, mom and pop investors, young professionals trying to build a rental portfolio. Anyone who's trying to buy a duplex, anyone who's trying to buy their first rental to build wealth, this is going to be a dagger to the heart. It's going to add friction. It's going to limit the way we as Canadians can use leverage to build wealth and try to either pay off our mortgage faster, security, freedom, independence for our own family, or trying to just get out of this rat race. So it quietly really does change who gets to play the real estate game in Canada. But let's focus on what you can control as opposed to just some doom and gloom negative story. If you already own a rental, you still have time to refinance that before November 1st under the old rules. And if you are planning on buying a rental property even after these changes, basically what you need to focus on is a stronger file. You have to show better cash flow, a bigger down payment, and a lender who actually understands how to structure your deal under these new guidelines. But I personally think, guys, the biggest takeaway of all this is, what was the goal in the first place? If your plan was to buy real estate, leverage it to buy another, what was the real goal? Was it to just own a ton of doors and manage tenants? Or was it freedom? Was it wealth? Was it security, right? The good news is you can still do that, even if Ottawa is making these rules tougher for you. You might just have to do it differently. You have to adapt, which means you can focus on other things. You can focus on other asset classes. And this is a disclaimer. I'm not a financial advisor, but more of a personal opinion for myself. You can focus on getting mortgage-free faster for yourself, building equity intentionally, diversifying your investments so that you're not super over leveraged and exposed to real estate fluctuations. I've always said it, but I think buying modest and investing the rest, whether it's in gold, it's in crypto, it's in ETFs, is a great way to continue to ride the wealth building wave, right? It's more to do with adaptation than anything. But that is exactly why I put together this cheat sheet, little PDF document. It breaks all this down in really simple terms. It'll show you how to calculate your new borrowing power. It'll also list a couple strategies for you to stay ahead, even amongst these rules. So if you were very weighted in real estate to grow your wealth, there are other ways that you can still continue to do that. Feel free to download it below, reach out to me. But if you are serious about understanding what's happening and how to adapt early, this document will basically save you a ton of confusion down the road. So ultimately, this isn't the end of real estate investing, but it is the end of an older, outdated playbook that our parents used or that past generations used. And if you do understand what's going on, you can still build wealth in this country. You can do it smarter, you can do it safer, and you can still do it on your terms. So guys, if this video did help you make sense of any of this, please do me a favor, hit subscribe, email me for that PDF or for a 15, 30-minute chat to talk about your situation. I think this next chapter in housing is less to do with gaining more leverage, but more to do with smarter leverage and smarter asset investing over time. So thanks so much, and I'll see you guys in the next video.